Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today we're going to look ahead a little bit to 2021 and kind of compare the opportunity between growth stocks and recovery stocks. Now that we sort of have two vaccines available and the future is looking much brighter in terms of getting rid of COVID and returning back to normal, maybe by the summer of next year, it's time to think about the recovery stocks that are out there that look intriguing, but compare them to longer term growth opportunities and try to figure out what the best balance is for you personally. Reminder as always that my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your research before investing in any stock. And of course, if you like stock market research, personal finance videos, please subscribe to the 40 Finance channel. Thank you to everyone who has subscribed and supported the channel to this point. All right, let's jump in. So the point again is to compare recovery stocks, which are starting to get a lot of press, and compare those to some of the growth stocks like tech, etc., to figure out like, hey, which is the better play, particularly for the long term. All of the stocks that I invest in, the goal is to hold them for at least a year. So that certainly changes the way I look at things in terms of short-term opportunities and long-term opportunities. Okay, so when we're talking about recovery stocks, we're talking about basically everything that bottomed out in March and has yet to fully get back to where it was, right? So things like travel, restaurants, transportation, entertainment. I think we've all looked at these across the board for several months thinking about, hey, should I get into some of these names knowing that eventually the vaccine will come out or the virus will go away and, the thought is quick money on the rebound. Now, in my case, and you see here on the second bullet point, it's just thinking about like, hey, am I leaving legitimate growth? So a company that's actually growing to get into a company that's really just clawing its way back to par. And I think the best example of that is going to be like your restaurants and movie theaters, right? Who are just absolutely devastated, down to 20% or less of their normal revenues. They have a long way to go just to get back to whatever levels that they were making money in 2019. And from my vantage point there's a middle ground. There is a place that offers recovery options, aka revenues are down slightly, but growth is still there. So I'm going to share a couple of examples of one that's kind of like clawing back and the other that is still growing. And hopefully that illustrates the point of the things to think about when you're offered these opportunities. All right, first company we have here is Boeing, and Boeing is an airplane manufacturer. So obviously with so many planes grounded, no airline has enough money to order new planes. So Boeing's business basically came to a screeching halt in all of this. In fact, they were lucky to keep anyone employed at a company like this. Luckily, they did have some Air Force contracts and national security things to keep the lights on. But you can see the obvious play here. Boeing at one point over the 52-week range was trading at $375. And now we're down to $200, and that's actually an uptick since the first vaccine news was called out. And then today we got a second vaccine that looks very promising. So in the back of your mind, you may be thinking, hey, 200 a day, guaranteed 375 in 6 to 8 months. And while that may actually happen, we do also have to think about how long is it going to take Boeing to get back to that level. So if you look off to the right of the screen there, I highlighted a few boxes, and these are the growth estimates given by analysts. You can see that the current year for Boeing is minus 157%, basically off of 2019, and not a lot of surprises there. Next year, in the green box, the sales growth is 116%. So the difference between the two is probably where Boeing stock is going to land in the short term. And then after that, in the next 5 years, we have a 12% growth rate projected over the next 5 years. Now, 12% growth rate is not bad at all if that's what they're doing in a normal year. But if you're watching the stock market quite a bit like I do, then you know that from a growth perspective, growth stock perspective, I should say, 12% usually isn't going to qualify for some of the companies that I'm searching to invest in. All right, next up in the comparison is Disney. And Disney, while they have gotten absolutely killed at the parks during the pandemic, they are a company that sort of had a backup, right? Because they had ESPN, Disney Plus, movie entertainment that they were able to distribute in different ways. So Disney is a stock that got hit on its revenue streams, but is also large enough to have different revenue streams. And in my opinion, the management did a very good job of sort of like changing direction and figuring out where the money was. If we look at the stock today, over the past year, you can see it only has $10 to go before you're right back at the levels of November of 2019. So some folks might look at this and say, well, compared to Boeing, Disney doesn't have as much room to run. Now, from my perspective, I would say that that statement is factually correct. However, when you start thinking about Disney's potential growth rate, and I've highlighted some of the numbers there, off to the right, you see in the orange box, the current year growth rate with the pandemic and the closure of parks was 4%. So they still mustered out growth, and I think Boeing was minus 150%. Next year, they're expected to grow 134%, and the 5-year growth rate comes in at 19.19%. So that growth rate is about 50 some odd percent higher than Boeing that we saw on the last slide. And Disney as a company is in a lot better position, not only to turn revenue on very quickly, because it's not going to be super hard to reopen the parks. They already have a capacity of 20% or something going on right now. But since they're still making money during these hard times, they're in a much better place between cash flow, etc., whereas Boeing is going to have to sell planes, and it could be a while before revenue comes back into their organization. So between these two stocks, Boeing and Disney, I would argue that Disney is in the better shape financially and could very well provide better long-term gains over the next 5 to 7 years. All right, so the point is everyone's going to have a different match on the recovery stock game, and here are some things to keep in mind as you're researching stocks. What is the timeline to par? We talked about the companies that are sort of struggling and they have negative comps for the year. How long is it going to take to get back to par if, as an investor, you're counting on that time period to get your losses back? This is where I think it makes sense to assign a percentage recovery, right? So I think with Boeing, the percentage recovery in 2021 is much less than Disney's recovery percentage. And what I mean by that is how much revenue recovery are we going to have in the first year of a vaccine? Boeing's might be 25, 30%. I have no idea. You will have to research that yourself. But Disney, if I could totally see Disney getting back to 65, 70% recovery if things go their way. So that's just my opinion, but it's something important to think about. Next, you see on the board, eventually PE and EPS are going to be a factor. So if you're jumping into a recovery stock, make sure it's one that can eventually post an EPS and ideally an EPS growth, right? Because that's really going to come into play as the market settles down. Think maybe the first 6 months of the recovery stock boom is sort of be Wild West with things going up and down. But eventually it's the business metrics that make a stock move, as well as the demand. So if you have a company with a lot of debt that's struggling to really put numbers on an EPS basis, that's going to show in their investor report, and it will turn some investors off. And the last point on this slide is just thinking about how much you're risking long-term growth for recovery. Could be zero, right? But you have to think about that. when you're jumping in. If you're into, let's say, restaurants or cruise lines, going back to the percentage basis of how much sales come back, and then when do they start growing again compared to some of your other options. All right, so now let's flip the script and think about growth stocks in a time of recovery stock boom, right? What is the opportunity there? Obviously, the prices are going to come down, and yet in some cases, the growth rates are going to remain unchanged. It was just that so many people had money piled into these growth stocks that the prices kept going up. When they started to leave for other opportunities, the prices came down. Here you're going to do the reverse, right? If we were talking about recovery sales, we're going to think about sales lost. So I'm just going to say Zoom for a minute. How much of Zoom's revenue goes away when people start returning to the physical workplace? Obviously, that could be a long time away, but you should pick a number for yourself to think about. Maybe it's 30%, maybe it's 50%, maybe it's 5%. That's where you have to do your research and read through investor reports to come up with that number so you know when you want to get out or get back in. And that brings us to the last point here. It's really good to assign a price target to some of these growth names that maybe you were excited about 3 or 4 months ago. That excitement lost its luster as the prices went down. So now's the time to do your research and get in and say, here's what I would pay for Zoom, right? I won't pay $500, for example. But if that price ever reaches $350, I know I did my research and I know that company is going to grow, and that makes it all the more comfortable for you to jump in on market dips. All right, a couple examples on the growth stock side. Etsy, this is one that I own. I bought in at 133, probably 2 or 3 weeks before the vaccine, and it has come down from a high of almost 155 to now 124.43. So a little bit of a slide, but I'll tell you, I was never once worried about my Etsy investment when I saw the price start to slide. And the primary reason why is for those growth rates that you see over there on the right-hand side. This year, they grew 175%, which is outstanding and certainly a byproduct of people being home and shopping on e-commerce more. Next year's outlook at 3.3% is definitely a little intimidating. I think that's light, but let's just say it's 0% for fun. It does make some sense that they would land there because there's just going to be more shopping opportunities for people, and frankly, physical retail is going to steal a lot of money. So if they end up being flat year over year from a long-term perspective, it's not the end of the world, because then you get into that blue box there, which is the next 5 years anticipated growth rate over 50%. I've done my fair share of research on this company. I think they will actually grow next year, but even if we hit some bumps in the road, I see Etsy having a very bright future. All right, next on the board, I picked Teledoc because it's obviously a poster child of the pandemic, and you can see with Teledoc, we have a price today at $177. The high was $253. So is Teledoc on sale? And this is one that I mentioned in an ARC video I did a day or two ago that is definitely on my radar. I'm not buying at $177 though, because I think it might go down even farther. And I need to do more research on Teledoc. But you look off to the right on their growth rates, they're in a different fiscal year. They're in the fiscal year ahead at 2021. So when you see that minus 5.8% in the orange box, it's basically comparing to the pandemic time. And you see that they're saying minus 6% for the year. That, frankly, is not that bad at all if you think about a situation where they went to a rarely used service to a have-to-have service. And in this fiscal year, they're only going to lose 6% of sales based on analyst projections. It might come in more than that, but don't forget they added Livongo, so they are going to have revenues coming in from that side of the business. But then you look to next fiscal year, which is essentially 2022, or the better half of it, 59% growth rate, which is super exciting. And then the weird thing here on Yahoo is they have their next 5 years in at under 1%. I would say that requires more investigation. This company does not have a positive EPS yet, so anytime you get in that situation, the algorithms start to screw things up a little bit. All right, so really the bottom line here, and I tried to pick some helpful examples, is that investments have opportunity cost, right? So that means when your money is tied up in an investment, other things are going on around you. Some of them will be better, some of them will be worse. The key is to think about your short-term versus long-term goals when it comes to investing and your risk appetite. I think that you're probably safe on things like Boeing, that they will go up. But how much will they go up, and at what point are you missing out on other sectors of growth happening? That's something only an individual investor can answer based on his or her preferences. And finally, as I mentioned earlier, the best thing you can do at this time, in my opinion, is to research all the stocks that you've really been attracted to lately but haven't purchased, and start making your own price targets. You can look at what analysts are doing to give you a guide, but dig into those PE, EPS, sales numbers. Look for where the growth is over 3 to 5 years when the world's back to normal, and that is where the majority of the money is going to be made. All right, guys, hope you enjoyed this video. Please give me a like and subscribe if you did. We'll see you on the next video.